No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about we always talk about taxes here at different times, and taxes are a big, important part of your retirement planning. If you understand, again, to be able to attain and maintain your standard of living and quality of life no matter how long you live, part of that to make sure those dollars stretch out and we don't run out of dollars, and we're able to, again, thrive in retirement, not just survive retirement, right? It's not just about getting by. If things get tight, I'll just tighten up and, I won't go out, or I won't, do the things that I enjoy doing. I'm going to just conserve my money. Wouldn't a better plan be to have a plan in place that says if the market's going down, your portfolio is going to be protected, okay? You're going to by that I mean properly diversified, utilizing asset allocation models that we have to reduce the volatility, increase stability, allow you to ride out that volatility in the marketplace. When it's going down by 40 or 50%, you're going to be protected there. You're not going to take near that type of loss, and you're going to recover from those kind of bumps in the road, if you will, much faster. So that's part of it. Now that's that part. It keeps more money in your pocket, right? If you're not having to worry about market losses, or if at least you can ride out the volatility just as you can when you're saving for retirement. To do that in retirement and still maintain the income you need and have that income going up with inflation, that's the key. Well, another part to that is we don't want to be just accidentally, we'll call it, or erroneously spending money on taxes, paying more tax than we're required legally to do. Does anyone want to do that? If you do, just write them a check. At least you'll know exactly what you're doing, right? Seriously, I had a client in just this week as an example, and this happens, almost daily, where we're going over, and whether it's doing reviews with clients, whether it's new clients coming in and we're getting their plans set up. One of the things we see is this about taxes. So an example, this gentleman's retiring this year, has retired this year actually, and he's making plans. Okay, I'm going to take a little bit of money out. I'm going to do some things around the house. I'm going to take some money out of my retirement account to do that, and we're setting up his income. And basically, once you go into retirement, right, the paychecks go away. Now, maybe you have a pension. Most don't, right? Or it's very small if you have one. You got Social Security, and what other income are you going to have in retirement? So in this situation, for most, it's going to be coming out of your retirement accounts, right? Those 401ks, IRAs, SEP IRAs, whatever it is, TSP, thrift savings plans, whatever it is for you, that's where the money's going to come from to supplement your income now to be able to maintain your standard of living. So in his situation, we're setting up that income for the balance of the year, and I'm looking at his income, and this is where understanding tax code is so important. Mostly he's just thinking, well, I'm going to take some money out, I'm going to do these renovations, and I'm going to have the income that I need, and I've got some projects I'm going to be doing around the house. And I said, well, what's the time frame for this? Because one of the things, if you take out this money that you're intending to take out, it's going to bump you up into the next bracket. And for him, that meant going over $100,000 in income. He was going to go from a 12% tax bracket to a 22% tax bracket. He was going to pay basically, if you take out $10,000, that's an extra $1,000 in taxes that you would be paying. Now in this situation, what happens? He worked a little over half of the year before retiring, so he's got all those wages that he made, and he made a good income. So that was what was going to create this situation that money he took out would be taxed at a higher rate. If we just wait until January and take the money out, then he's only going to have to pay a 12% tax on it instead of a 22% tax on it. Okay, so again, save you just that one little thing, save you $1,000 in taxes for every $10,000. So if it's going to be $20,000, right? That's $2,000 in savings. That's the kind of thing, is just being aware of how the tax code works. And here's another part of that: Social Security. Okay, your Social Security taxes, understanding how that works when we do these calculations. So I'm going to give you an example. We're going to do a little brain teaser here to start. We're going to talk about tax planning changes through 4 stages of retirement. This is a great program that I picked up from a company called Horse's Mouth that does a lot of different research on different topics, and this one was a great one. So first one is just a brain teaser. So let's see if we get this slide up on the tax brain teaser. And this is about a gentleman, they say, Bill, we're going to get that slide for us. Bill is retired and has taxable income of, taxable income of $42,675. So he's in a 22% tax bracket. Good. Single individual, right? Includes $38,000 in IRA income and $25,000 in Social Security benefits. He taps his IRA for an extra $1,000 and for a concert road trip. How much will he owe in taxes on the extra $1,000? And this is where they're saying, by the way, excuse me, when they're talking about this, to make sure this is clear on this $42,675, that's his, it's not adjusted gross income, that's his taxable income, that's after his deduction. Okay, so that's how much, and that's what's pushing him up into that 22% bracket. The next piece is he is, as you can see from the tax brackets there on the right of your screen, okay, if you're over $39,475, that's what pushes him up into the 22% bracket. All right, so if he takes an extra $1,000, how much is he going to have to pay in tax on that? And of course, what it would appear to be, right, is 22% of $1,000. Or $220. However, there's a little trick in there, right? There's a little trap that goes with it. So let's take a look at that next slide. All right, how much tax will he owe on the extra $1,000? If he took $1,000, you would expect it to be $220. That seems simple enough, doesn't it? However, that's the wrong answer. The right answer, in fact, is he will owe $407 in taxes. A 40.7 tax rate on that income. And thinking, how could that be, right? Well, this goes into what the craziness, the madness of our tax code. The unique formula, in fact, there's a thing called the provisional income formula that has to do with how your Social Security benefits are taxed. And this is what pushes Bill up in this situation to paying almost double the tax that he would have expected on that $1,000. Now, this goes in, if you think about it, if you're even in the top bracket, if he was making over $500,000 of taxable income, the top bracket's 37%. You would think, how could you possibly have to pay 40% tax on $1,000 when that's way above the highest tax bracket? Well, this is where we're going to get into this more in the program today, because this is where the understanding how the tax code works is so important. And with me today to help with that is my good friend and special guest, Dr. Friday, with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. All right.
Good morning.
She is good morning. Good to see you again. I've known Friday for like 20 years.
Yes.
We're like family now.
It feels like it.
So, one of the things you get into is the understanding how the tax code works. And by the way, if you need help with your taxes, Dr. Friday is the tax expert when it comes to not only individuals but also small business owners. And this is one of those areas. A lot of time when I have new clients coming in, sometimes people when they retire or are contemplating retirement, they're thinking, I think I might want to work part-time. I might want to, or start a business. I may want to do a consulting business. I've got these skills from my work life that are highly marketable, but I'd like to, now be able to call my own shots, work my own schedule, say if I want to work 2 or 3 days a week, that's all I want to work, or 1 day a week, or take off a month, or whatever it might be. This is, one of the things that they look at is that freedom and flexibility. And when it comes to that, then it's like, well, do I set up as a sole proprietor? We just had a client, I think yesterday or the day before, that we met with, and that was exactly what they're doing, thinking about a consulting business or maybe getting into real estate and, should I set up as a sole proprietorship or a partnership or a C corporation or S corporation or limited liability corporation, all these questions about both the tax issues as well as liability issues. That's one of the areas that she can be a big help to you as well. All right, we're going to jump in. When we come back, we're going to be talking about how tax planning changes through the what we're going to dissect out as the 4 stages of retirement, and how that differs just as investing does, just as most anything does. And we'll show you how that works and how you can hopefully give you some tips that you can use to improve your situation as well. All right, but first we're going to take a break. Join us here. We'll be right back on the Retirement Report.